Europe. Well, some strategists say part of the global sell-off has to do with concerns about China, the investing climate there. Ratio of non-performing loans at Chinese banks rose to the highest level in 2 years. In a Fox Business exclusive, we welcome hedge fund manager and author Jim Rickards. He has just published the book, The Death of Money. Jim, I know you have been on the road, traveling. Thank you for joining us. Thrilled to have you.
Thank you, Deidre. First of all, congratulations on your new show. Thanks for including me among your early guests.
Thrilled. So in addition to the book, which of course we are going to talk about, I don't mean to bury the lead, I have to ask you first and foremost about China. You're a China hand, a known expert. I just read out that non-performing loan statistic. How much of that is a concern? To what extent should investors be focused on it?
I just got back from China last week. It's very much a cause for concern. Non-performing loans is part of it. These wealth management products, which the chairman of the Bank of China has described as a Ponzi, and it is a Ponzi. The ghost cities, which we've talked about in the past, but I've been there, got mud on my boots, saw them, construction as far as the eye can see, all
construction
empty.
As far as the eye can see, and I was going to say, but no one there, and no businesses ready to move in.
Right, so one site, it wasn't 7 buildings, it was 7 cities. Each city had multiple buildings, etc., all empty. So China has been driving its GDP with investments, about 45% investment. But a large percentage of that investment is wasted. So if you were sort of keeping a balance sheet and you just wrote off the wasted investment, their growth would already be lower than they've been saying. I'm not saying they're lying about the numbers. I'm just saying
many people do.
Many people do, but even assuming the numbers are correct, a lot of what they're reporting should just be written off to zero. So their actual growth is probably around 5%. It's going to go even lower than that. So you're going to see a credit crisis, a run on the banks. Now, they do have plenty of money to deal with it. They have $1 trillion.
And there's a lot of internal controls, yes. Right? And they have, let's say, less restrictions than what we do here. So if the government wants to fix it, it can.
Well, they think that, and they have $4 trillion in what the IMF calls precautionary savings, so they can throw a lot of money at it. But there are all these hidden spillover effects. For example, I was in Japan in September '07. Their stock market was collapsing. They said, hey, we understand you Americans have a mortgage problem, but why are our stocks going down? Well, the reason was hedge funds were selling Japanese stocks because they were liquid to get cash to meet margin calls on the mortgages that they couldn't sell.
So you basically don't buy this argument that China is contained, and because there's not a Fed in the same way that we have a Fed and the government can step in any time, you just say it doesn't matter.
Every time we think it's contained, it's not, because of the linkages, what's called the density function. Things are so connected. So a Chinese bank that has investors lined up at the door will sell U.S. stocks if they have to get money to pay the depositors. So that's how the linkages work.
So, Jim, what are the implications then for people who own U.S. stocks? Why should they be concerned?
Well, look, China is 10% of global GDP. If you slow China down by half, which is what I'm expecting, and we're starting to see that, that's a big impact. I mean, U.S. growth is already anemic. Europe is weak. We know that story. Japan, they've been in a 30-year depression. So if you slow China down, again, this means the whole world is...
But, Jim, even half GDP, that's still better growth than the U.S. So even if it slows down, I've heard this argument, that's still pretty good.
5% is still pretty good. It's certainly a lot better than the U.S. I'm just saying that China's the only thing really driving global GDP at this point. So this is really symptomatic of the worldwide depression that we're in. We've been in since '07.
All right, Jim, hold that thought. We're going to continue the conversation. Jim is going to be back with us, talk a little bit more about the dollar and gold. Jim, by the way,